Let's say you are considering investing in Dubai real estate. You could buy either a ready property or one that's under construction, and you'll need to pick an area: Marina, The Palm, GVC, Arjan, Creek Harbour, Dubai Hills. And to make it even more complex, also a developer: Emaar, Damac, Ellington, Sobha, Danube, Azizi. There seem to be so many choices. You might have even seen those ads on social media from real estate gurus, each one promoting different projects and claiming you'll get rich by buying what they are selling. On top of all this, there is a very real fear of potentially losing all the money you've worked so hard to earn. To clear things up, we've created this ultimate guide by answering the 26 most important questions our clients ask. Each question is time-stamped below, so you can jump to the sections that interest you most. We'll break this video into 4 parts. Part 1 will help you decide whether to invest at all. Part 2 will guide you on selecting the right property. Part 3 covers everything you need to know about paying and closing the deal. And Part 4 is all about making money from your property. Part 1. Making a decision to invest. The first question: is now a good time to invest in Dubai real estate? The short answer: yes, it's a good time. But the longer answer might surprise you. First, despite the rapid growth, prices aren't actually that high. Take a look at this graph from Knight Frank. It shows the average price per square foot. In March 2024, prices were almost the same as in 2014, which is the last peak. There is just a 2% difference, and that doesn't even account for inflation. And let's not forget how much the city has changed since then. Dubai is way more livable now, offers great benefits for investors, and has improved its regulations significantly. Second, compared to other global cities, Dubai is still priced relatively low. On average, it takes about 15 years to pay back your investment from rental income here. In New York, it's 20 years. In London and Sydney, it's over 30 years. And in places like Zurich or Hong Kong, you should expect 40 years or more. The difference is even more striking in the prime segment. With $1 million, you can buy 980 square feet in Dubai's prime areas. Compare that to just 366 square feet in New York and 237 square feet in Hong Kong. Third, demand is still strong, and Dubai is well positioned to keep it that way. Surveys show the high willingness to buy here. For example, according to Knight Frank, 44% of global high net worth individuals are considering buying property in Dubai. For those worth $15 million or more, that number jumps to 78%. And Dubai continues to generate demand. Tourist numbers are at historic highs, expected to hit 19 million in 2024. It matters because people who've visited the UAE are much more likely to buy real estate here. It's like the top of the funnel keeps expanding. And also there is the growing resident population. Dubai aims to increase its population by 75% by 2040. That's ambitious, sure, but even if they get halfway there, it will still have a massive impact on the real estate market. Now, the second question. What benefits do I get as a Dubai property owner? How do I get a residency or golden visa? There are 2 types of visas you can get, each with slightly different benefits. The first one is called the investor visa. To qualify, you need to spend a minimum of 750,000 dirhams, which equals about $200,000. Here's what it gives you: a 2-year residency visa for you, your spouse, and your children. You can renew it after 2 years as long as you still own the property. The ability to open a bank account. If you want to live in another apartment in Dubai, you can rent one long-term. This isn't available for non-residents. You can enroll your children in UAE schools, and you can apply for a UAE driving license. To maintain this residence, you must visit the country at least once every 6 months. If you don't, your visa will be cancelled. So if you'd like to secure residency for 10 years without need to visit the UAE regularly, you should go for the golden visa. To qualify, you need to purchase property worth at least 2 million dirhams or about $546,000. Here's a pro tip. Recently, it's become possible to get this type of visa after paying just 20% down payment and the 4% DOD fee. So there is no need to wait for the construction to be completed anymore. With a golden visa, you can also include your parents, and there is no age limit for your children, unlike the investor visa, which doesn't cover sons older than 25. And this brings us to the question number 3. How much money do I need to buy a property in Dubai? Well, the range in Dubai is pretty broad, but the minimum starts at around 150,000 US dollars. Let me give you some examples across different price tiers. Affordable tier. These are areas like GVC, Arjan, Sports City, Al Furjan and Dubai Land. Price ranges. Studios are from 150,000 US dollars to 220,000. One bedrooms are between 200,000 and $340,000. Two bedrooms are from $300,000 to $450,000. And three bedrooms are from $520,000 to $700,000 US dollars. A good example in this range is the Imtiaz Cove edition in Dubai Land. For roughly $250,000 US dollars, you can get a one-bedroom apartment with high-end amenities like rooftop pool, gym and even a jacuzzi in some units. High-end tier. These are prime locations like downtown Dubai, Creek Harbour and Dubai Hills, known for excellent materials and amenities. Price ranges. Studios are from 320,000 to 500,000, though some areas like Creek Harbour don't have any studios. One bedrooms are $400,000 to $800,000. Two bedrooms are from $620,000 to $2 million. And three bedrooms are starting from $1 million and can reach $3 million or more. For example, a one-bedroom in Benghazi Skyrise, which is a 3-tower complex in Business Bay, starts from $450,000 US dollars. Now, luxury tier. These are super high-end locations for the wealthy, like the Palm, Emirates Hills, Jumeirah Islands and Blue Waters. Prices start at around $1 million US dollars. For example, a one-bedroom on Blue Waters runs between 1.5 and 1.8 million, while a two-bedroom is 2.5 to 3 million, and a three-bedroom can go up to 4 million. More exclusive properties like apartments in top luxury hotels are even pricier. A two-bedroom in Atlantis the Royal on the Palm with a sea view can cost $5 to $7 million. Villas in prime areas range from $3 million to up to $50–60 million in Dubai Hills, for example. Essentially, there is no upper limit, but buying property in Dubai doesn't always mean paying the full amount up front. Developers often offer flexible payment plans, which I'll discuss later in this video. What are the property acquisition costs besides the price? It depends on whether you are buying from a developer, this type of deal is called off-plan, or purchasing a ready property on the secondary market. First, off-plan acquisition costs. Purchase price, 4% Dubai Land Department fee, and $1,500 US dollars administrative fees. Then, secondary market costs. Also purchase price, 4% Dubai Land Department fee, same as off-plan, 2% agency fee, trustee and legal fees, which are approximately $4,500 US dollars combined. So, for example, if you're acquiring a property priced at $500,000 US dollars, the total for an off-plan property would be $521,500 US dollars, and the total for a secondary market property would be $534,500. Next question. What would be my expenses after the purchase? Let's break it down. First, service charges. These are fees paid to the developer for property maintenance, including common areas like pools, gyms and parking. They typically range between $3 to $6 per square foot per year. For example, a one-bedroom apartment may cost around $2,500 to $4,000 US dollars annually in service charges. A two-bedroom may be $3,000 to $5,000, and a three-bedroom $4,000 to $6,000 US dollars. Second, housing fees. If the property is not rented out, you'll pay a 5% fee based on the annual rental value as assessed by Dubai municipality. For example, if your property assessed rental value is $20,000 per year, you'd pay $1,000 in housing fees. But if you rent out the property with a 1-year contract or longer, tenants cover this fee. And third, if you do not rent out and live in the property yourself, you'll have standard utility bills like water, electricity, internet and gas. The next question was quite popular for some time. Can the property be taken from me? It's possible, but easily avoidable. The thing is, there are two main types of land and property ownership in UAE: leasehold and freehold. A leasehold means you're basically on a long-term lease. You can rent out the property and resell it, but after 99 years you have to give it back to the original owner. This kind of ownership is often significantly cheaper. The other type is freehold. You own the property completely and forever. No one can take it from you, and you can pass it on to your kids and grandkids. Currently, freehold dominates the market. Leasehold properties do exist in Dubai, but they're becoming much less common. Now let's discuss what every investor wants to know. How much money can I make, and what is Dubai's real estate ROI? Obviously, this varies a lot depending on the area, unit and time frame. So let me give you some average numbers and then an example of a successful area. Let's start with an average Dubai apartment's performance since 2016. I am choosing this period because it's long enough to include various macroeconomic fluctuations. The amount invested in such case, including 4% DLD fee, would be $364,000. Average price increase since then is 52%. Rental income over the years is $138,000. Service charges over the years are $39,000, and the total income would be $280,000. The total return on investment is 177%. This ROI is not discounted and doesn't take into account inflation, but this gives the good enough indication. And this number basically means that if you bought an average apartment in Dubai 8 years ago and sold it now, you would have paid back the initial investment and made 77% on top of that. Now consider a more recent investment. If you bought an apartment in 2021 and sold it in 2024, your ROI would be 159%. This is because Dubai experienced a period of rapid growth, with prices increasing by 50% over the past 3 years. And if we look at villas, the returns are even higher. If you purchased a villa in 2016, the ROI would be 198%. If you bought one in 2021, the ROI would be 185%. These are averages, of course, but some investors made particularly smart choices and outperformed the market. For example, those who invested in villas on Palm Jumeirah back in 2016. Let's take a look at this investment case. Amount invested, including 4% DLD fee, is $2.7 million. Average price increase is 210%. Rental income over the years is $1.4 million. Service charges over the years $95,000. Total income almost $6.8 million. Return on investment 351%. Even those who invested in Palm Jumeirah villas in 2021 achieved a return on investment of 256%. These are exceptionally high returns for such a short period of time. And of course, you shouldn't expect these numbers from just any random investment in Dubai. So the next question is, who will help me to make a great real estate investment? Forever Estates, of course. We'll help you find the perfect property, explain the payment plans, run all the numbers, and guide you through the purchase process. We handle everything end-to-end, and it's absolutely free. Just scan the QR code, click the link below the video, give us a call, or message us on WhatsApp. My team will be happy to consult you. And the final question in this section: what if the developer goes bankrupt or tries to escape with my money? The first thing you need to know is that to register a new real estate project, the developer is required to get a bank guarantee. This ensures the performance of obligations. If the developer fails financially, the bank covers their obligations with its own money. Second, payments go through an escrow account. This means the developer doesn't have access to the money you've paid until they reach certain construction stages. Here's how it works. When a developer wants to build a new project, they must open an escrow account in a government-regulated bank, overseen by the Real Estate Regulation Authority. The developer then deposits 20% of the total construction cost into this escrow account. This proves they have the funds to start construction. After that, all buyer payments are made directly into the same escrow account, every single payment. The developer cannot access this money until specific construction milestones are achieved, so they cannot just take your money and disappear to some offshore heaven. And this, I think, closes the first part. Let's get to the part 2, selecting the right property. First question, and it's maybe one of the most important ones. How do I know if the specific property is worth investing in? We have a detailed video on this, but in a nutshell, the process is the following. First, formulate your investment goal and make sure the evaluated property aligns with it. If your goal is securing savings, look for properties with high rent-to-price ratio. To maximize long-term profits, focus on early-stage projects in early-stage communities. For quick profits, target unique, highly demanded units in rapidly growing areas. Whenever possible, prioritize reliable, high-quality developers and unique units. Often it's not about the price, because Dubai offers high-quality options across all price segments. It's more about expertise and making rational choices. Second, estimate the cost and ensure the unit isn't overpriced. For ready properties, check transaction prices in the same building, not listings, actual transactions. For off-plan properties, find relevant benchmarks, like similar buildings in the same area, and don't forget to factor the service charges. Third, calculate potential income. If you are planning to rent the property out, look at similar units and check their rental rates. Then, estimate potential value growth based on the area and the performance of the similar unit. Fourth, calculate key investment metrics like return on investment and cash-on-cash returns. Compare these metrics to other properties in your consideration list and make your decision based on the results. What are the best areas to invest in? Before I answer that, a couple of disclaimers. First, this answer changes over time as new areas emerge and older ones become fully developed. Second, our recommendations will vary depending on your personal circumstances and budget. So here is a kind of universal list. 2 areas that are great for renting out are GVC and Arjan. They have an excellent rent-to-price ratio of about 7% on average and 9 to 10% in the best projects if invested in at the right moment. Also, they are growing in line with the market. For value appreciation, some existing but still rapidly developing areas like Greek Harbour and Dubai Hills. Greek Harbour will host the next record high building and the largest mall, meaning that its greatest days are still ahead. Dubai Hills, on the other hand, is uniquely green, which is an incredible asset in a desert urban city. And a couple of areas that are just starting development but promise to be exceptional are Oasis by Emaar and Dubai Islands. Oasis is targeting high net worth individuals with spacious villas and townhouses surrounded by greenery and situated near a lagoon. Dubai Islands is a beachfront community on artificial islands, just 15-20 minutes away from downtown, being developed by Nahil. That's the same company that built Palm Jumeirah, one of the most lucrative investments in Dubai's history. All the details, along with the numbers to back these points, can be found in this video. What are the best developers for investing? We have a separate video covering 10 developers we consider the best in Dubai, and some of them are still under the radar for most investors. But for now, let me share a few of the most well-known ones. First, Emaar, of course, the largest and most popular. Their projects are so in demand that they often sell out within hours. One of the great things about Emaar is that they develop closed master communities where no other developers are allowed to build. This lets them increase prices with new launches and drive growth across the entire area. Second, Nahil. They're responsible for creating huge areas that have significantly outperformed the market, like Palm Jumeirah. Villas on the Palm have tripled in value over 10 years and more than doubled in just the last 3 years. Third, Miraz, a premium developer behind some of the Dubai's most desirable communities, like Marina, Jumeirah, Bulgari and Blue Waters. Prices in Blue Waters, for example, have increased on average by 117% in 3 years, compared to 44% across the Dubai market as a whole. Should I buy a secondary or an off-plan property? From an investment point of view, both options can bring great profits, but the choice will heavily depend on your circumstances and goals. Let me guide you by outlining the key points for both options. What speaks in favor of off-plan? If you are not a resident and don't have the full amount upfront, or prefer not to spend your entire budget right away, off-plan properties offer more flexible, interest-free payment plans. This is especially relevant for non-residents, since getting a mortgage is unlikely for them. I'll share more details on that later. Buying properties under construction allows you to make extra money because the building gains value during the construction period. It also lets you enter an emerging area at its earliest stage, with greater potential for appreciation over time. Off-plan purchases are also easier process-wise. You work directly with the developer, complete the transaction quickly, and don't even need to visit Dubai. Why a ready property might be a better option? If you need a place to live in Dubai immediately, waiting several years for construction isn't feasible. If you are a resident, you can get a mortgage. And if you've chosen wisely, the rental income could cover your mortgage payments entirely, or at least a significant portion. If your goal is to start generating rental income as soon as possible, a secondary market property is ideal. It's ready for occupancy and can begin generating returns right away. Keep in mind that buying property on the secondary market is a much less streamlined process. It can often take 3 or 4 months in total. You'll need to get a mortgage approval, if applicable, find a property you like, negotiate, and finalize the deal. During this period, prices may fluctuate, and sellers can sometimes change their minds at the last minute. Now that we've discussed property selection, it's time for part 3, which is paying and closing the deal. The first question is the one that we hear quite often. Can I get a discount? Yes, you can. If it's a ready property, you can negotiate the price directly with the individual owner. But if you're buying from a developer, here are some strategies to get you a lower price. First, go for a stricter payment plan. When developers offer flexible plans, allowing you to pay a big chunk of the price over several years after the construction, the price is often 10 to 15% higher compared to the standard plan. Second, increase your down payment. For example, pay 40% instead of the standard 20%, or even pay the full amount upfront. This can lead up to a 10% lower price with some developers. Third, for big investors, purchase multiple units. Buying a full floor is even better, and the best discounts come when you acquire an entire building. It's also worth noting that not all developers are willing to reduce prices, especially if demand for their projects is so high that units sell out within hours. So there is no point to provide any discounts. The second question in this section is, how much do I need to pay upfront? Let's break this down. For off-plan, it depends on the stage. At the expression of interest stage, you pay a sum of your choice, usually with a minimum amount like 7 or 10,000 US dollars. Once you choose a unit, you typically pay 10% of the property's value. The down payment is 20% of the unit price, which includes what's already paid at the previous stages. And additionally, you'll pay a 4% Dubai Land Department fee and around 1.5 thousand US dollars in developer admin fees. For secondary properties, if you're using a mortgage, the down payment depends on the bank's terms and your circumstances. For residents, it's typically 20%. For non-residents, it's 40%. You'll also need to pay a 4% DLD fee, a 2% agency commission fee, and trustee fees. What financing options are available and which one should I choose? Well, it depends on the type of property you're buying. Mortgages are not available for off-plan properties, only for secondary ones. And even for secondary properties, mortgages are less popular among foreign investors because the down payment is typically 40% compared to 20% for residents. The interest rate is also significantly higher, and approval chances are lower. When buying directly from a developer, you can choose a flexible payment plan. These plans are structured so that part of the payment is made during construction, and the remaining balance is paid after you receive the keys. Different developers offer different splits. The share paid during construction usually ranges from 40 to 90%. Payments are typically tied to construction phases and spread over several years. And sometimes developers provide multiple payment plan options. For example, Imtiaz often offers two, 50-50 and 70-30, where the remaining 30% is repaid equally every month over 30 months. Pay attention to how the price differs, as such flexibility often results in a price increase of about 5%. Do I need to visit Dubai to buy a property? As I briefly mentioned earlier, no. If you're purchasing a property in the off-plan market, everything can be done fully remotely. You'll choose the exact project and unit with your agent, make the payment, and then, after some time, the developer will send you the sales purchase agreement. Then you sign it and continue paying remotely. However, if you're planning to buy a ready property, you'll need to visit Dubai. It's mandatory that either you or your legal representative is present during the transaction. What is the process of buying a ready property? There are 7 steps. Step 1. Agree on terms with your agent. This includes the price range, area, number of bedrooms, and the commission, which is typically 2% as per market standard. Once agreed, you sign a contract between the broker and the buyer. Step 2. The agent starts looking for properties that meet your requirements and organizes viewings or online tours until you find a property you like. Step 3. After finding a property, you issue a check as a deposit, which should be at least 10% of the property price. This deposit shows your commitment and protects the seller if the buyer changes their mind or disappears after signing the Memorandum of Understanding. And the step number 4 is signing the Memorandum of Understanding. This is a standardized document from the Dubai Land Department that details the sale terms. Step 5. Hand over the deposit check. And step 6. Finalize the property transfer at trustee office. A trustee office in Dubai is an authorized third-party office that facilitates real estate transactions on behalf of the Dubai Land Department. They ensure the transfer process is correct, verify documents, and process the payment. The trustee office also collects the DLT transfer fees and other applicable fees. At this step, you or your representative must be present in Dubai. And the final step, step number 7, the Dubai Land Department issues the title deed in your name. The next question is the same, but about off-plan. What is the process of buying an off-plan property? I'll try to make it straightforward. Just 5 steps. First, submit an expression of interest. This step is optional and usually applies if the project is in the pre-launch phase. To express your interest, you make a fully refundable prepayment, typically starting at around $7,000. This gets you on the list of buyers, and those who pay earlier or contribute more get a priority and can choose available units first. Step 2. Book the apartment. This happens if the developer hasn't yet set up an escrow account. You'll pay 10% of the total price to reserve the apartment you've chosen. In return, you'll get a booking form containing details about the unit, including size, view, payment plan, and resale conditions. Step 3. Make the down payment. The down payment is usually 20% of the total price, with the 10% booking amount included. Around the same time, you'll also pay a 4% Dubai Land Department fee and small developer fees. Step 4. Sign the contract and pay the balance. The document you'll sign is called the Sales Purchase Agreement, or SPA. Developers can take up to 2 months to prepare it, and once signed, you'll start making payments according to the agreed schedule, which is typically tied to construction milestones. And the final step, handover. At this stage, you inspect the property, and if you find any defects, the developer is responsible for fixing them. Once everything is finalized, the property is handed over to you, and you receive the title deed, officially confirming your ownership. By the way, we have a detailed video on the step-by-step process of investing in real estate in Dubai. Check it out if you want more in-depth information. And this brings us to the next question. How do I make a payment? If you're in Dubai, you can visit the developer's office and pay in cash, by check, or simply tap your card on the terminal. And if you are outside the UAE, you can pay online by making a SWIFT transfer, use an online checkout with your card, or even pay via cryptocurrency. Many developers here accept it. Next question. What if I fail to pay? First of all, try not to. Of course, there are cases where a buyer's financial situation changes unexpectedly, but quite often, people end up unable to pay because they A. assumed they could sell before handover, B. didn't anticipate that construction might progress faster than planned, or C. live in countries with complicated money logistics and didn't streamline the process in advance. If the buyer does find themselves in this situation, there are 3 stages of reaction. First, grace period and notifications. The developer will notify the buyer via email that the payment deadline has been missed and will request the outstanding amount. Second, Dubai Land Department involvement. If the buyer still doesn't pay, the developer is required to notify the Dubai Land Department, which will then issue a 30-day official notice to the buyer. This notice serves as the buyer's final opportunity to settle the payment. And third, consequences of non-payment. If the 30-day notice period expires and the buyer has neither paid nor reached an agreement with the developer, the DLD will issue an official document in the developer's favor. Based on the stage of construction, the consequences are as follows: 80% or more completed. The developer can request that the DLD auction the property to recover the outstanding amount. 60 to 80% completed. The developer may cancel the agreement and retain up to 40% of the property value. Less than 60% completed. The developer can terminate the agreement and keep up to 25% of the unit's value. As soon as you realize that you might face difficulties paying on time, notify your agent and the developer immediately. This gives enough time to negotiate a potential solution. And the final question in this section: which document will prove my property rights? It depends on the stage of your property. During the off-plan stage, the key documents are the sales purchase agreement and the OCUD certificate. After both parties sign the SPA, the developer must register the sale with the Dubai Land Department. And once you've made the down payment, the DLD will issue the OCUD certificate. This document includes information about the property and its owner and acts as an off-plan version of title deed. Once the property is completed, you'll receive the title deed, which is the official document proving ownership of the exact property. Alright, now that we are done with the third part, let's get to part 4, making money. The first question: is it possible to resell the property during construction? Yes, it is. But I think there are actually 2 questions behind this question. First, are you allowed to sell the property during construction? Different developers have different conditions for reselling a unit, but typically you are free to do so after paying 30–35% the property price. Second, will someone buy a property under construction from you, and will you make a profit? The truth is, many factors can prevent this. Reselling during construction works best with highly demanded and unique assets. If the unit isn't particularly special, buyers are more likely to go for a ready property. And if the developer hasn't sold out their inventory, buyers may choose to purchase directly from the developer instead of paying a premium to you. Next question: do I need to furnish an apartment before renting it out? If you want to rent out the property short-term, like on Airbnb, then yes, furnishing is necessary. However, if you're renting it out with a long-term contract, you don't have to. In Dubai, it's common practice to rent properties either completely empty or with just the kitchen appliances. That said, some tenants specifically look for well-designed, nicely furnished apartments or villas, and they're willing to pay extra for them. So in certain types of properties, and if you are able to make an additional investment, it might be worth considering. Another question about the rent: how to rent out the property, and who will manage my property? Let's break this down into two scenarios: long-term and short-term rentals. First, long-term rent. Once your property is handed over, you can start the process. You'll need a real estate agent who will handle everything, including finding tenants and preparing all the necessary documents. In Dubai, rental payments are made through checks. Tenants provide named checks. They can only be deposited in your favor. These checks have specific dates written on them, and when the date arrives, you simply deposit the check into your bank account. The entire process, collecting and depositing checks, is managed by the agency. For landlords, those services are free because agents earn their commissions from the tenant. Additionally, tenants are responsible for utilities, property maintenance, and housing fees. They are also required to return the property in the same condition at the end of the lease. The only expense that remains with the owner is the service charges. Second, short-term rent. In this case, the property must be furnished or upgraded before it can be rented out, unless the developer has already done it. Alternatively, you can delegate this to a property management company, as they have the expertise and have done it hundreds of times. A property management company will also manage your listings on platforms like Airbnb and Property Finder, dynamically adjust pricing, address guest complaints, and organize cleaning services. This approach involves additional costs. Besides the service charges, you'll also pay utility bills, housing fees, and a management fee to the property management company. These management fees are typically around 20% of the rental income. Now, let's discuss the sale. What is the process to sell a property? We can break it down into 6 steps. First, agree on terms with the agent. Start by finalizing the selling price, agent commission, and arrangements for handling the keys. Once everything is agreed, you'll sign the agreement between you, the seller, and the broker. Step number 2, the agent will advertise your property and show it to potential buyers. If you're okay with public listings, your unit will be posted on key property search websites. Step 3, sign the Memorandum of Understanding. Once the agent finds a buyer, you'll sign the Memorandum of Understanding. This is a standardized document from the Dubai Land Department that outlines all the terms of the sale in detail. Step 4, buyer issues a deposit check. The buyer will issue a check for at least 10% of the property price as a deposit. This serves as proof of intent and protects the seller if the buyer backs out or disappears after signing the MOU. Apply for a no objection certificate, or NOC. You, as a seller, must apply for an NOC from the property developer. This document confirms that there are no outstanding fees or obligations on the property and that the developer has no objections to sale. The cost is usually up to $1,000. And the final step is the property transfer at a trustee office. These offices are authorized third-party facilitators for real estate transactions on behalf of the Dubai Land Department. They ensure the process follows regulations, verify all documents, and handle the payment. The trustee office collects the DLD transfer fees and any other applicable charges, which are typically paid by the buyer. And the final question for today: what are the costs when I sell the property? For you as the seller, there are only 2 main costs. First, agency commission. This is the fee you agree upon with your broker. And second, no objection certificate that we've discussed in the previous question. The cost is typically up to $1,000. And that's all for today. But we've got plenty more valuable insights to share. If you want to learn more, check out this video.